Fine. So, okay. So I'm
All
actually
right.
second here because I'm going to actually show you something I show that gives a little more detail on some of the commercial stuff. So hold on one second. I'm going to
Okay.
presentations here. I think you might find it valuable. We'll jump around a little bit based on the questions. So
Okay.
let me see. But knowing that quite a few of you focus on that, let's go a little deeper.
Okay. Perfect.
All right. Can you see my screen?
Yeah, we can.
Perfect. Okay. Well, hello, everyone. I'm not sure if I've met everyone, all of you, but my name is Sheila Long, and I am a certified exchange specialist. I'm actually the only certified exchange specialist for the Old Republic family. So I teach this course to real estate professionals, CPAs, and attorney board associations. So we're going to have fun today. I'm going to give you some information. We'll touch a little bit on some topics. I see some hazards in the commercial world, and I'm a res-mercial girl myself, so I definitely deal with both. And I've done everything from these small the small commercial transactions to $70 million hotel transactions. And so I've been involved personally in working with the taxpayer and their counsel and tax advisors as well. So with that being said, I am here locally in Arizona, and I cover the Southwest mountain states and California. And why I tell you that is because there's some state specific laws that I'm aware of as well that can really get in the way for some of your sellers that are out of state. And I'm on my 25th year. I come from a background of taxes, and my mom works for the IRS. I'm glad I'm not there in person, so you can't hold me hostage. So, but I was thinking about it the other day, and my mom spent her whole life working for the government and trying to squeeze money out of us. And my dad's a small business owner, and so he spent his whole life running from the government. So they're obviously not married, but I see it from both sides. I'm somewhere in the middle. So with that being said, I'm going to start with my presentation, and I'm going to encourage you to stop and ask questions. This is really a small group today. So if there's those scenarios or the what ifs, let's go into that in-depth dive. And my background as well, as I have to get my continuing education, I look at quite a different range of audit risks for taxpayers, things that they can get away with. And obviously, Sean is not going to put this online, so we can talk about whatever we want as goes in depth as you would like to go. So with that being said, you do see my name here. I'm part of the Old Republic family. I'm not title. I'm not that home protection. Old Republic owns multiple companies. And so why I point that out is because you have relationships with escrow companies and title companies, and you can work with any title company that you want. I am simply handling the tax deferred exchange. And we also insure our exchanges, as this is not a regulated industry. I'm not sure if you're aware of that, but anyone can hold your client's funds. And what that means is that anyone can do what they want with those, which could jeopardize those taxpayers. Okay, so why I point this out is because a lot of times people will call and they'll say, do I have to open up escrow with your sister company? No. Okay, I simply handle the 1031 exchange. We're a qualified intermediary, right? As you know, the IRS requires a qualified intermediary in between escrow, the taxpayer, and someone holding their funds. Okay. So I just want to review some of the guidelines. We're going to start with the basics that you know. I think it's a good refresher to open up our mind and create some questions here. So I'm going to review a couple of the basics here with the timelines, and definitely want to go over some hazards that I see in the commercial world as well. All right. So as you know, there's a tax code that's for our investors, right? It's for the investor held property. And the IRS basically states, and I love how they state this tax code, and I really want to break it down on what it should say, not what it actually states. And this tax code should say it's for any taxpayer, US citizen or foreign national, so long as they have a tax ID number. So your clients that are that are living out of the country, that own commercial buildings here or residential, they can exchange. Okay. And as long as they have a tax ID number. All right. So no gain or loss is recognized so long as that taxpayer sells and buys another investment property, any investment property. Okay. For equal or greater in value. That's so important to understand. This equal or greater in value to have 100% tax deferral. And a lot of times these taxpayers think they can sell a property, buy another property, pay off that loan at closing, and just reinvest the difference. Okay. And you see this mistake quite a bit where taxpayers on I feel like it's a little more on the residential side. They don't realize that, say, they have to replace their basis, their gain, and encumber the same amount of debt to get up to the equal or greater in value, whatever that is. Okay. Now they can always do a partial exchange. That's possible, and it will expose them to taxes. However, to have 100% tax deferral, so no gain or loss is recognized, they must buy again of equal or greater in value of like kind property. And we'll break apart that like kind. I find it so valuable to really know what that means. So before I do, I just want to quickly give you a couple guidelines here on what to make sure you're doing, and make sure of, obviously, the 1031 exchange for the investor to investor. Okay. Investment to investment property. That's what that is. Okay. So for my residential agents on here, you need to make sure that they're not going to go and buy a primary home, or at least not right away. Okay, so there is a revenue procedure that states that no exchange will be challenged if truly held for 24 months or more. Okay, that's 2008-16. And I'm giving you that because a lot of times people will go, well, I'm going to, and I was involved in a really large golf course transaction in Arizona, and there were multi-members, and we worked on this for 2 years. You know how these are, right? Daryl was just talking about this 3-year run with these commercial clients. Yeah, so they take quite a bit longer than the average 30-day close. And one of the owners that held the golf course in a tenants in common went and bought a home in Montana, and that was sold the golf course and bought a single family. And they were planning on renting it out, knowing fully that what their plans were down the road, holding it for investment for 2 years or more before they go move into it. So these are great exit strategies, Daryl, like that client that has that dated commercial building. If maybe they go, well, listen, forget the working on it, sell it for a little cheaper, and we're tired of being a commercial landlord. Maybe we go buy a single family vacation home, rent it out for 14 days or more a year. That's it. 14 days or more for 2 consecutive years, it's considered held for investment. So gives quite a bit of ideas on how to plan, right? This is an estate planning tool. This is a way to defer and keep the dollars in our pocket, obviously, right? So long as they sell, they must buy like kind again. And I'm going to break that down right now. Okay. Because how did that guy sell a golf course and buy a single family? I'll tell you why and how. And the third one, there must be an exchange as distinguished from a sale and a purchase. What does that mean? It simply means it needs to be set up. It needs to be established. It can't just be a sale of a property and the acquisition. It's got to have an exchange. Okay. And so the exchange is set up by an exchange accommodator. You can simply put it in your contract or an addendum, or if it's not in either, we're going to draft an exchange agreement anyways. Okay, so what that third one really just means is it set the exchange up in advance. I will tell you a great tip on why it is wise to get your clients with a qualified intermediary in the beginning, and because I can review some potential hazards with them when they're looking at offers. All right, so let's talk about this like kind, okay? Because this is the big misunderstanding where a lot of taxpayers don't realize this is actually the biggest area of mistake with our CPAs. I'm not sure if you're aware of that, but this area right here, I feel like I spend so much time when I'm meeting with CPAs and talking about this like kind because they take it literal. They don't realize that any property held for investment or for trade or for use in trade or business qualifies. They take it literal, residential for residential, commercial for commercial. No, your clients can absolutely take that raw land they're sitting on and buy a shopping center, a commercial building, maybe sell an apartment or multifamily for single family, that golf course for a single family vacation home in Montana. And that one day is going to be their forever home. And I did this, I was involved in again, let me give you another example of this like kind. This hotel that I was in, I mentioned being involved in a hotel transaction in 2018. The hotel was in Guam. So you can actually exchange in the US and US territories, most of them. So Puerto Rico, unfortunately, and US Samoa does not count towards the tax deferral. They have their own tax treatment. But this exchange was in Guam, and they sold a $70 million hotel, and they went to California and they bought 13 different properties. Okay. And it's quite interesting that they bought 13. I'll tell you a little something here. It was obviously this hotel was a partnership. And as I was reviewing the corporate returns and looking at the members, you want to know how many members there were? 13. So it sounds like they were planning ahead, right? So it's definitely one of those things where these multi-member entities, like that golf course, right? There was like a dozen there too. They want to go their own way and they plan ahead. And I'll give you some tips on how to do that when we're working with clients with multi-member partnerships. But not one of those properties, like I said, was another hotel. Okay. So just want you to keep that in mind for this like kind. It's such a valuable tool to help solidify maybe that listing where they might not want to go buy another commercial building equal or greater. Was there a question? I heard a little voice there. Sean, any questions? Anyone have questions?
I don't see any, so no, I think I just a couple people are off mute, so
Got it. Okay. All right. Well, feel free to ask. I do want to let you guys know, right? Even fee simple for a 30-year leasehold qualifies. Okay. And I do this a lot with mobile home parks as well, where they are selling, trying to sell the business and they're questioning if the leasehold can work. And it does, as long as there's a 30-year qualifies.
Hey, Sheila, can I ask a quick question?
Yes. Hi, George.
Hi, how are you?
Doing well. Thank you.
One of the things that we've been exposed to recently, which is a relatively new, at least to me, is the Delaware statutory trust concept, or also opportunity zones as being, qualified for exchange purposes. Could you just comment on that real quick?
Absolutely. So the DST, the Delaware Statutory Trust, I'm seeing that as an alternative, or one where, say, someone sells for 500,000 and they found another property for 400 and they don't want to do a partial exchange on the difference. So this DST is this great strategy to add on their identification list to use up any proceeds that may have been considered taxable. Okay. And this DST, typically they're anywhere from 50,000 to 100,000 minimum that the taxpayer must buy into. What they're buying into is a larger asset, like a Banner healthcare facility, storage units, okay, an Amazon distribution warehouse. And they take their, say, 100,000 that's left over, right? And they go buy a percentage of tenants in commons. They're actually on the deed holding real property, benefiting, right, from the gains, the losses, right, if there are any, and able to defer their depreciation recapture. So they're quite a great tool. I've seen someone sell for 500 and take all of it into DST. I've also seen sometimes where they're just trying to cover that boot.
Okay.
Those are great strategies. Some of those companies that do that are like Inland Securities, Cantor Fitzgerald, Morgan Stanley, and they have to use an advisor that is will place them into one of those products.
Sure. Thank you.
Yes, absolutely. And opportunity zones is my nemesis. I always joke and say, use those in a failed exchange and buy into one of those funds. as they will be able to defer and have some small forgiveness of gain. However, since that was implemented in the last administration in 2018, or 2017, 2018, as we get closer to 2026, unless they revamp and change the dates, this ozone is not as sexy as it once was. So
Yeah.
think of it as a failed exchange where they only have to put in their gain and not the equal or greater.
Okay.
All right. Okay. So just a review on the timeline that we know that's there, and that unfortunately does not get extended unless there's a natural declared disaster, like what happened in California. I tell you, California really should be their own state. I'm just kidding. I'm originally from there. I'm allowed to make fun of them. So they really, the great Republic of California was granted the whole state almost. I think there's 57 or 58 counties in California, and all but 7 were granted an extension for the floods that happened and from in January and December. So this extension right here, this timeline stays in place for us that have very little natural declared disasters. There's no extensions on this. So just want you to be aware of it. If you remember the hurricane that happened in Florida, they had an extension for the whole state. When that freeze happened a few years back with Texas, they had one. Okay, the rest of us are stuck to this timeline. And this timeline starts the day your clients close in the relinquished property, so long as they set the exchange up in advance. It's very important that the taxpayer gets the QI involved early on if they can. A lot of times commercial transactions, there's multi-layers to these entities, these partnerships, right? And as a qualified intermediary, we have to figure out who the true signer is. So we're following the true entity docs, and we'll have to do our own review as well, which is what title does. Title does their review on their end. The exchange company does their review on our end, and setting it up too far in the game could cause delays and stress. So I really want us to put that out there to you guys to make sure your clients are starting and establishing that exchange early on if they can. Okay. And the day they close is day 0. They then have 180 days to complete the acquisition and 45 days to identify. All right. And I like to say that in real estate, everyone has their own role. And our role as a QI is to make sure we provide them with the forms and have them complete those forms. So we let them know, here's your timeline. Here's your date. Here's a reminder, 2 more weeks until this timeline expires. Okay, so we really are providing them with the tools that they can so that you can just make sure you help them acquire again, help them buy again, help them sell and help them buy. And we do all that, the nitty gritty details of the timelines and the guidelines. Okay, for those in commercial here, an LOI, I have had an LOI accepted as a proper form of identification if we can obtain proof that the LOI was received by the seller by the 45th day at midnight, even though the seller wants to strike out everything and take a month to review. We do have accepted an LOI when the wording buyer intends to acquire this through a 1031 exchange. Okay, so that's one of those things where I always say, even though you can check a box in there saying that there's an exchange, if you can put that in there, buyer intends to acquire this through a 1031 exchange, we have accepted an LOI after the 45th day with proof that the seller did receive it. Okay, and so we obviously have to document it. It'd be best if they fill out our forms with identifying the property, but I have had those one-offs where, you know, we needed to show proof that they really did intend to acquire that property. Does that make sense?
Yeah. So you can fill out the forms, you can submit an LOI, and those are different forms of identifying the properties, but you don't have to start negotiations on the property. You could just fill out the forms with you.
Correct. So say that they
Okay.
have a list of properties together and they're still, they haven't even sent over any negotiations, but they know, I think I'm going to buy one of these properties. They can absolutely identify that prior. Everything just has to be done prior to that 45th day. Okay, so it doesn't have to be in contract at this timeline. I always say it's wise, or be very diligent in ensuring that you will get an accepted offer, because again, there are no exceptions for adding on properties after the fact. Okay. All right, and then there's some rules. I won't go into this too heavily. We all know the 3 property rule. If anyone has ever heard, everyone thinks you can only identify 3 properties, right? No, it's actually it's the easiest rule, because with this tax code, the IRS loved to make rules and riddles. And I tell you that these other 2 riddles that they call rules are challenging, and it will be determined by their sales price, how many properties they can identify. So let me give you an example. The 3 property rule is where you can identify up to 3, any value, okay, but no more than 3. Okay, so they could sell for 500,000. They can identify 1 for 500, maybe 1 for 5 million, and maybe 1 for 50 million. Okay, it doesn't matter the value. Okay, but when they want to go over 3 properties, they have to follow something called the 200% rule. And bear with me, this is where I joke and say it's like a riddle. They can identify any number of properties so long as the fair market value of all of those properties added up does not exceed double of what they sold for. So let me give you an example. They sell for 500,000. They can identify 4 or more, but the total value cannot exceed $1 million. So when I have someone selling, say, a piece of land or a smaller property for 200,000, and they say, Sheila, how many properties can I identify? I tell them 3. But when I have somebody that's over there selling for 2 million and they say, Sheila, how many properties can I identify? I let them know, well, you have choices. So you see how the sales price determines which rule they may fall into. And again, this is something I want you to file and forget. Just know it's there, okay? And there's one exception to this rule of 200%. They can identify any number of properties with no regard to value, so long as they acquire basically 95% of all the properties they identify. Isn't that interesting? I mean, I really don't know of any number until 100 that 95 ever works out evenly. So these are really those things that we work on with your client. Okay, file and forget that. Call Sheila. All right. Watch out for fix and flips. And we're going to dive into some hazards here. I do want to let you know there's no magical holding period from one sale and an exchange. So if your client bought a property just really quickly because they wanted to make sure they stayed within that timeline, okay, or they bought a property and they found out the homeowners association won't allow short-term rentals. Remember, those vacation homes qualify, right? Okay. And I wanted to give you just some examples of where the IRS really looks at intent. And did your client intend to hold it for investment, or do they have like dealer status where they fix and flip? Okay, and we give you 2 cases here where someone held it for only 4 months and it was considered a valid exchange. But then someone held it and moved into it too soon or used it for personal use. And regardless of the amount of years, they were not supposed to exchange that, right? Can't exchange your personal home. You can't exchange a home that's simply used as personal use either. So you have to think of second homes versus vacation homes. Remember, the tax code states a vacation home qualifies as held for investment if it's rented out for 14 days or more. That's it. So tell your clients, and those of you in this room here, let's make sure we're holding our property as vacation homes versus second homes so that we can protect that equity. All right. So there are some hazards that I want you to be aware of, okay? And one of them is really like the restriction on the funds. So I'm going to kind of toggle back to the timeline again and show you this. Okay. I really want you to watch out for credits to buyers and be aware of the same taxpayer and partial exchanges. Okay. And this is where we go a little heavier but I think it's important for you just to be aware of it. Obviously, don't quote it. You're always just supposed to be that source of the source. Okay, call your QI, talk to your CPA. And these are things that I notice, and I'll give you some examples on credits with some commercial transactions I've been involved in that really caused some taxable consequence. Okay, so let's talk about the restriction on funds real quick, and look at the timeline slide. Why am I talking about the restriction of funds? Because as a taxpayer, the IRS requires that we have a certain level of access to our own proceeds. Okay, it's called the G6 restriction. And it basically tells when a taxpayer can access the funds and for what. And so I'll just give you an example here. So starting on day 0, the moment they sign the exchange agreement, the taxpayer can only access the funds for earnest money deposits or for the acquisition of replacement property. Okay, starting from day 0 to day 45. If they forgot about me and they ran off on a cruise to Fiji, or they just didn't identify a property, they're eligible to receive the funds on day 46. Okay, so they can only access the funds for earnest money deposits or for the acquisition of replacement property. Okay, here's the kicker. Say on day 50, they identified a property or properties, and they just couldn't come to agreement with the seller, and they decide to cancel the exchange. Now that they've identified in writing and they're past day 45, the IRS now states not only do they have a failed exchange, but they can't even access the funds until day 181. So here's where, and I mentioned, and for anyone that might have came on late, this is not a regulated industry. And it's very important that the taxpayer knows who's holding their money, how's it insured, right? You know, with all that bank failures and odd stuff that was happening earlier in the year, it's really important they understand, or that $70 million that we held, we were holding almost all of that in cash. There was little debt on it. And who's holding that? Okay. And so it's really important to know these restrictions can get in the way. It's something I joke and say I only made 2 mistakes in my career as a QI and about this timeline and this holding restriction. 2 times, I don't think I was clear enough about this holding restriction, and the taxpayer come Monday morning on day 46 dropped the F-bomb. And I'll tell you, it really sets my whole week when they start the day like that. So it is one that I do not tiptoe around. You need to make sure your QI is very clear, because when their funds are held for an additional 4.5 months, you can see, and not only do they have a failed exchange, they can't even access it. They're not happy about that. All right, so just showing you real quick on capital gains, and this is something I think everyone just needs to be aware of. Anything under a year's taxes as ordinary income in their bracket of 10 to 37%, depending on where they fall, but anything over a year is taxed at the long-term gains. And we are taxed on the federal, we're taxed on the state, unless you're in one of these 0% states like Nevada, Washington, Tennessee, Florida, Texas. They don't even know what that word is. And so, and you know, all of our Californians who are coming here as fast as they can, right? It's because the great state of California has the highest state tax in the nation. Okay, and they're talking about raising that. So we're taxed on the federal, we're taxed on the state, we're taxed if we're considered in a higher income bracket, and we're taxed on something called depreciation. So it just goes on. And if your clients are doing a full exchange for equal or greater, they can defer all of this. The one negative is a partial exchange. See, depreciation is not pro rata. What does that mean? That means that they're taxed on the full amount. So if they fully depreciated the property for, say, the last 30 years, okay, or more with commercial, right? So they've fully depreciated the property and they want to do a partial exchange, they're going to pay tax on that depreciation recapture. All right. So it's definitely something that I want to talk about again as we talk about credits. Any questions on so far, or on capital gains?
I had a quick question a few slides back on the fair market value of the properties, the 200% rule.
Yes.
How does the IRS determine fair market value?
Yeah, so it's really interesting that I always say, right, who really determines fair market value? It's the buyer and the seller, right? Not when it comes to the 1031. They're going to go back, and if your clients were right, because if we see an ID notice and it simply said that they sold for 2 million and they're identifying 4 or more properties and they say it's worth 4 million, we're going to take their word on it, right? Because it shows fair market value, they list it $4 million. However, the IRS has been known to go and look and see what did it actually sell for? What was it listed? So it's as if it benefits them. When it benefits them, this is when it can be scrutinized. And fortunately, I'll give you some insider trading tips. So I mentioned my mom works for the IRS, and she said she's always one to tell me once it goes public, once somebody else leaks something, I'm allowed to know. The IRS did deem, the IRS commissioner stated in writing that they will not audit anyone under 400,000 right now. They just do not have the capacity. People like my mother are aging out. And so that's kind of good news to know that those that are making under 400,000 as a taxpayer, our combined income are not going to be audited right now. They just don't have the capacity. And you know who's auditing more than the IRS? The state of California. So at second to California is New York. So a lot of what I review is the audits that are coming out of those states, because there's very little guidance with the 1031 on the IRS level. And so we look at seeing what has sort of been before and how the IRS might deem something. Okay, so that fair market value, Sean, unfortunately, even though the buyer and seller should determine that, right? When it comes to the 200%, it can be questioned if they simply put a number down just to honor the rule, yet that's not really what it was sold for. Make sense? Any other questions? Okay, so I just want to let you know, watch out for credits. Okay, now this equal or greater, I want to give you some good news as we dive into this. The good news is that your client must buy equal or greater in value, less fees. So those commissions, okay, anything that you see on here that they can't get away from, the transfer tax, okay, exchange, escrow, all those fees reduce what they have to buy for. Okay, it takes it right off the top. It's like the one-time fees are in our favor. And I love sharing that because sometimes we have taxpayers that are free and clear, and they tell me, so you're saying, Sheila, I need to buy equal or greater, yet my agent's over here taking 4 to 6%. And now I'm going to have to go negotiate that. And I let them know, actually, it's equal or greater, less fees. I'm working for your commission too. So I'm telling them, listen, equal or greater, less fees. However, there are quite a few potential taxable consequences that you want to watch out for. Okay. And a lot of times taxpayers in these bigger deals will say, let's just take the security deposit and give them a credit through closing. I don't want to deal with getting my property manager to do this or that. And let's just do a credit. If you can avoid it, bring cash to the table, do it outside of escrow. Okay. Watch out for these credits. The biggest one I'm seeing is credits for repairs. And I want to give you an example. And this was a pretty sad case I was involved in several years back. And it was, I believe it was 2017, because I remember it was before when we used to be able to exchange businesses. Okay. And that was the one change from the last administration. We used to be able to exchange art, airplanes, automobiles, livestock even, and businesses. Okay. And I was talking to the taxpayer as I do the initial consultations, and then I assign them to one of my 5 exchange officers. And the taxpayer I can recall was selling his car dealership. And he'd owned it for many decades. And I remember this sweet older gentleman, and he said, kid, back in my day, I used to say that if anyone ever offered me 5 million for my car dealership, I would take it, because that was a lot of money for me, and I'd move on and retire. And I remember him saying that. And down the line, as we got further on into the exchange process, as you know, they take forever on commercial transactions. My team started blowing me up on my phone, and it said, Sheila, we need you to look at this. I alert my team if they see a credit over 10,000, I need to give a disclaimer to the taxpayer, letting them know that any credit that you see on here is considered boot, taxable cash. So the settlement statement comes in and the sales price there was an addendum that we were not made aware of. The sales price was increased to 6 million with $1 million credit. I can still get chills to this day. And so I had to call the taxpayer and I said, hey, listen, because we have to close, right? We have to sign off on anything that comes our way. We are not their counsel, and we're not we can't be unbiased. So I said, hey, Mr. Taxpayer, I saw that the price increased to 6 million and you're giving $1 million credit. Congratulations, we're closing tomorrow. We'll proceed, but I need to give you a disclaimer that this $1 million is now treated as boot. And he said, well, here's why this happened, was because the seller said, hey, listen, just let's increase the price to 6 million. You give me $1 million credit so I can build a suit. And the seller, the taxpayer, said, what do I care? I'm still getting my 5 million. So guess what happened? So immediately I let him know it could be boot. And you know, with commercial transactions, Sean, and the rest of you, everyone is on this email, right? We've got all the agents, the transaction coordinators, CPAs on both sides, right? Legal advisors, aunts, uncles, the whole world is on this thread. And in all caps, the CPA of my client, the seller, he wrote to the agents, all caps, stop this transaction. It is a potential $1 million taxable issue to my client. Well, guess what the buyer said? Too bad. He signed that addendum. And so remember this, because in that case that I mentioned to you, that was so shameful, unfortunately, it could have been prevented had the QI been involved in all these additional negotiations, right? I now let them know, let me know before you give credits right away, because guess what? The IRS saw it as a partial exchange. Even though he didn't get 6 million, he now was treated as if he had $1 million boot issue. He had fully depreciated it. Remember, I told you he'd owned it many decades. So guess what? He now had the depreciation that he had to pay back. He was in the highest tax bracket. It was California and Bakersfield. And you know where his income was? It was much higher. And so it's really something where I say, if you can avoid giving any sort of credits in any way, that's really going to be helpful for a client. Okay. Really just tell your clients, talk to their qualified intermediary. Let us give the bad news. All right. Here we go. Just quickly on partnerships. I really need you guys to know on your partnerships, the golf course with multi-members, it was a partnership. We spent 2 years dissolving the partnership with the CPA's approval, turning it into tenants in common, allowing each taxpayer to take the benefits and the gains and losses from that golf course so that those that wanted to exchange could exchange. And really making sure you know that the same taxpayer who sells has to be the same taxpayer that acquires. So had that entity Golf Course LLC sold, right, guess who would have had to exchange? Golf Course LLC. In that example, okay? So planning ahead is wise to try to avoid doing what's called a swap and drop, okay? And really trying, this is really where, or drop and swap, they go both ways, depending on how they're doing it, okay? And so in the event that they had changed the title so close to close, it creates a paper trail, right? You've got your listing, you've got your contract that says Golf Course LLC and or assignees. That's a paper trail, right? So these things where if a taxpayer knows in advance, we're going to sell this in a couple of years, and I will have those relationships with taxpayers where they know, especially in commercial, that they're not going to sell today, but they might sell in a year. How do we handle this? Okay. And so really knowing to watch out for partnerships, as whoever sells must buy again. Okay. And remember the hotel in Guam, what they were doing is they sold as Hotel LLC or Hotel Partnership, whatever that their name was. Okay. They went and bought those 13 different properties with their goal to now keep those properties under the partnership for 1 to 2 years and then dissolve the partnership and each person take their own property. That is what I would just infer, because it was so coincidental, and I just had fun with that one. I don't know, or nor do I follow it, but I'm pretty sure that's probably what they were going to do. Okay. So watch out for seller carrybacks as we start wrapping this up here shortly. Just want to let you know, watch out for seller carrybacks. Okay, why? Because remember the equal or greater. And if your client's selling that raw land for 500,000 and their buyer comes in and offers 200,000, well, what about the difference? The exchange has to be set up in advance, right? So when that balloon payment comes due in a year, guess what? It no longer qualifies for the tax treatment. Okay, so being careful with that, and I always say to them, the higher they sell for, then they may want to just seller carry and exchange. But I usually will have the conversation and say you're going to do either or. Okay, then they'll take that seller carry back as an installment sale, taking the proceeds and paying tax just on the principal payments received. Okay, so this is sort of what we do as a qualified intermediary, and not everyone, not all QIs are made the same. I can go a little deeper as a certified exchange specialist, as I'm trained differently. I'm only one of few in the state that actually have that designation and can go and dive a little deeper with your clients, with their tax professionals as well. Okay, there are different types of exchanges. Sean, are we good? Did you have any questions?
Yeah, this was a little bit more on the, so there is a way to do a 1031 exchange with a seller financing. How would you recommend like that scenario?
Yeah, so first, when I get that situation, if they call me in time and haven't quite executed that contract, I ask them if they're sitting on cash. So say they're going to sell for 5 and buyer comes in with 2, and I'll ask, can you loan them the cash instead? So that all the funds, the 500,000, can go into your exchange account for you to buy again. And so sometimes that happens. They'll go, yeah, actually I am sitting on cash and I can do that. Or what they'll do is they'll say, okay, let's try to find a third party that can buy the note. Or maybe the seller pays off the note in the 180 days so they can complete their exchange. And really, it's treated as a partial exchange. Okay, so if our client say sold for 500,000, but they originally bought for 2, and their buyer's coming and giving them only 200,000, there would be no point to exchange. Does that make sense, Sean? They really only would want to exchange and do a seller carry if their basis was much lower, right? Their adjusted basis was much lower and they were sheltering some of it. And I will see that where maybe it's a commercial transaction where they're selling it for, let's say, 5 million, and they're going to carry 2 million and as a note, right? And exchange the difference because they really only bought it for 1 million. So they're still sheltering quite a bit. Okay. And so again, it is case by case on that taxpayer and if it makes sense for them. Does that answer a little bit more?
Yeah, that makes sense. That's very interesting. I hadn't thought of that.
Yeah. And Nolan, I see your little box kind of lit up for a second. Did you have a question?
Nope, I just didn't. I thought I was muted.
Okay, no problem. Unless you want to make up one. So, okay. All right. So there's just different types of exchanges. I'll show those with you here. Okay. The most common are the delayed and the simultaneous. And there's a reverse and improvement exchange. They're quite costly. They require a lender that is involved. If the lender's there that approves this. Okay. So I just want you to know that though, that there is a way to acquire the property first, and as well as do improvements on a property with exchange proceeds as long as it's set up. But these exchanges, where a normal exchange is anywhere from $1,000 to $2,000, depending on the size and if we're paying interest. The reverse exchange and the improvement exchange start at $8,500 and $9,500. So they're not for everyone. And I definitely, let them know you need to make sure that this makes sense for you, because this is before any additional escrow and title fees, because there's a whole nother escrow that has to happen with us being involved and parking title to one of the properties. So that they can really be upwards of 15,000 in fees with and transfer tax and all that to do these. So just for the sake of time, I won't go too deep into that, okay? But do know there are some options. All right. So as I mentioned, just watch out for knowing it's not a regulated industry. And the one thing I do like to point out, Old Republic Exchange, we're in our 30th year, actually, this year. And we have never had a failed exchange under audit because of something we've done. So with that, we have now carried the highest bond coverage in the industry. It's not something you pay for, it's something you earn. And so we can really protect against quite a bit more than the average. So just want to share that with you. Here's my information. I want you to pull out your phones, put 1031 Sheila. You're going to forget my name. And I think phone is my favorite way to communicate. I think it's a dying art. Too many people rely on text and email. I say pick up the phone and call me. We get so much more done just by answering the phone in a 5-minute conversation than me reading for grammatical errors in the email, since I'm such a stickler on that. So call me, put 1031 Sheila. I'm here for you, even if your clients are with another QI, but you just need a question or they're not hearing what they are understanding how it's broken down. I'm happy to answer that. And I want to leave a little bit of time for questions if you guys have any, or we can review some of the slides again.
Anybody have any questions?
Only a million.
Daryl, go for it.
Very, very good. Very good. Thanks, Sean, for recording this, because I'm going to watch this again and again and again. No, it's good stuff, Sheila.
Awesome.
I've not really had at this point, a lot of 1031 interaction or anything like in the transaction or anything, but I know it's coming. So yeah, thanks, Sean, for putting this on. Sheila, yeah, you'll hear from me, I'm sure.
Oh, good.
Yeah, with a question or two, but no, it's good.
And this one went a little deeper since I heard that you guys do some commercial in here. So yeah, I can always come back and do a real basics, but I threw some basic in there. I just wanted you guys to be aware of some things that could trigger seller carryback, partnerships, right? People trying to go their own way. And if I'm involved early on, I can address some of these issues before they start assigning contracts in the middle of a transaction. So let me know where I can help on that, Daryl.
Right. Thank you.
Thanks, Sheila. Great information, outstanding information, super helpful. So we appreciate you coming today and sharing all this wonderful information, and as usual. So anybody else have any other questions? All right. Well, thanks everybody for coming. And thanks again, Sheila. Everybody have a great day, and we'll talk to you guys later.
Thank you.
Thanks, Sheila.
Reach out anytime, guys. Have a great day.